Hello, my name is Isaiah, and this class is Intro to Financial Accounting. In this video, I'll explain the accounting cycle project and the steps I completed in part one of the assignment. So this project walks through the full accounting cycle, beginning with journal entries and ending with post-closing trial balances. So the first step in the accounting cycle was recording the journal entries. So in this step, I analyzed every transaction and recorded it in the journal entry using the double entry accounting system, which is that every transaction affects at least two accounts and total debits must always equal total credits. So for example, when the company paid an advertising on December 2nd, advertising expense increased and that cash decreased. Because expenses increased with the debit and cash decreased with the credit, the entry was recorded as a debit to advertising expenses and a credit to cash. Recording transactions this way ensures that accounting equation, which is assets equals liability plus equity, remains balanced. So another example was when the company received $4,150 from a customer on December 4th. In this case, cash increased and accounts receivable decreased because the customer was paying an outstanding balance. So cash was debited and accounts receivable was credited. So after recording all the journal entries, the next step was to post those entries onto the general ledger, which is right here. So what the general ledger is posting each transaction into its individual account so we can track how balances change over time. So for instance, every transaction affecting cash was posted to the cash ledger account. Every transaction involving accounts receivable was posted there, supplies, prepaid insurance, etc. This step allows us to determine the updated balance for every account. So once that's done and the journal entries were posted to the ledger, the next step was preparing adjusted entries, which is right here, for the end of December. So adjusting entries are necessary because some revenues and expenses occur over time and must be recorded in the correct accounting period. Excuse me. These adjustments ensure that financial statements following the matching principles, meaning expenses, are recorded in the same period as the revenues they help generate. So one adjustment involved would be computer supplies. So here I made a mistake, I made an error. The correct equation is beginning supplies plus purchases minus ending supplies. Where I got this 1,965, which is not correct, is I started with the beginning supplies of 2,645 and minus the ending supplies. So that is incorrect. I forgot to add the purchases of the computer supplies. So what it should be is 2,645 plus the 1,800 minus the 680 for a total of 3,765. So this should be 3,765. My mistake. I looked over it, but that is the correct equation, being beginning supplies plus purchases minus ending supplies. That's how you would get that number. Other adjusting entries include recognizing that insurance that had expired during the month, recording wages that employees had earned but were not yet paid, and recording depreciation for both computer and office equipment. The company owns the office and computer equipment, so these assets lose value over time. So depreciation expense allocates the cost of the equipment over its useful life. So straight line depreciation was used to calculate these depreciation expenses. So after posting the adjusted entries, the next step was preparing the adjusted trial balance. So what the adjusted trial balance is, it lists every account and its balances after adjustments have been recorded. This step ensures that total debits and still equal total credits and confirms that the accounts are ready for financial preparation. So using the adjusted balance, the financial statements were then prepared. So the first statement is the income statement, which is right here, which shows the company's revenue and expenses for the period and determines whether the company earned a net income or incurred a net loss. So in this example, computer service revenues was $43,604, and total expenses was $16,487. Those expenses including wages, rent, depreciation, advertising, supplies, and other operating costs. So subtracting expenses from revenue resulted in a net income of $27,117. So next is the retained earnings statement, which shows how net income and dividends affect the company's retained earnings during the period. Finally, you have the balance sheet, which reports the company's assets, liabilities, equity at the end of the period. So it's basically just giving a snapshot of the company's financial positioning. So after preparing the financial statements, the next accounting step are the closing entries. So right here as of December 31st, 2027. So closing entries transfer the balances of temporary accounts such as revenue, expenses, dividends to retained earnings. This resets those temporary accounts to zero so the company can begin the next accounting period with clean balances. So the final step is preparing the post-closing trial balance, which is right here. So the post-closing trial balance, the purpose of it is to verify that only permanent accounts, so assets, liabilities, and equity, remain with balances after closing entries have been completed. So basically, this just confirms that the books are ready for the next accounting period. So overall, this project demonstrated the full accounting cycle, from recording journal entries to posting them in the ledger to making adjustment entries, making the financial statements, which is income, retained earnings, balance, closing the books, to verifying the final balances. So each step plays an important role in ensuring that financial information is accurate and useful for decision making. Thank you.